Hi Forex traders, you welcome back. This is Carrie's Trading Institute and this is our new week commentary for the dollar and foreign currencies. So just as usual, the first thing we like to do is to first of all check what's happening on the fundamental basics. So we like to go to forexfactory.com so that we have an idea of when and how the volatility is going to come into the marketplace. So we are taking note of high and medium impact news events on forexfactory.com. okay, so this is Forex Factory calendar, and as you can see on Monday we have we may have a quiet day on Monday because we do not see any medium or high impact news events. That's how you know a low volatility day, a day that is going to have a less probable setup. All right, or even if you have the setup, there isn't going to be that delivery in price. Okay, it might just be a consolidation day. All right, a day when you have completely no medium or high impact news events on the economic calendar. That's how you know a low volatility trading day. All right, so on Tuesday you can see that we have a lot of high impact news events from 8:15 a.m. This is GMT +1 time, so you convert this to your local time or make sure that this is reflected in your local time. If you want to just change the settings, you can just come here and click on the time here and make sure it reflects your time. All right, so we are going to have a high impact news event on the euro, on the GBP, and on the dollar, okay, on Tuesday. So we expect to see price forming the high or the low of the week during this time. All right, especially during the high impact or medium impact news events. That's when we expect to see price form the high or low of the week in confluence with the weekly market profile. The weekly market profile teaches that usually price will manipulate retail, okay, to form the high of the week between Monday, Tuesdays, and Wednesdays, and then we see the true distribution, all right, into Thursday, and then Thursday New York session we might see the midweek reversal, or going into the Friday New York or London session we might see the week reversal. Okay, so the high or low of the week usually forms between Monday to Wednesday, and it forms most of the times during this high or low medium impact news events. All right, so that's totally a different topic. That's not what we are focusing on today. We are just focusing on analyzing the dollar and knowing where the direction of the dollar is, and then implementing the opposite on the foreign currencies, our tradable assets. Okay, so you can see on Wednesday we have a lot of high impact on the NZD and GBP, and that means that the NZD associated pairs will see some level of volatility, like the NZD USD, NZD CAD, whatever it is. Then GBP, we have a CPI 7 a.m. on Wednesday. All right, so you just go through it and identify these events and take note of the time and the day that these events are going to come into the marketplace. So that's just how to do that. All right, so you put it in your journal. This is the dollar monthly time frame. Usually we start from the higher time frame because the higher time frames are the drivers of liquidity. Okay, so we study institutional order flow of the higher time frame, and what we are doing on the higher time frame is that we like to know what's the current institutional order flow of the higher time frame by simply studying where price has traded away from, or where price just traded from. All right, and then where is price currently, using price delivery algorithm, or something called the interbank price delivery algorithm, which teaches us the 4 elements of a trade setup. All right, number one, we have accumulation. When there is no contract in the marketplace, the institutions would like to accumulate orders until there is sufficient contract to inject liquidity in the marketplace. Then we see an expansion coming into the marketplace. All right, what retail usually call what is it called now, an impulse swing in the marketplace. Then we see retracement, and when an objective is met, we see reversals. These are the 4 elements of a trade setup that we like to study while we are doing our institutional order flow analysis. So currently we see that the dollar previously had traded bearishly, then we had a shift of market structure. The dollar repriced into a premium mitigation block. All right, I have emphasized here, I have taught the differences between a mitigation and a breaker block, and I have also taught the 7 institutional reference points available in the marketplace. You may want to go down and watch that video right here on this channel where I taught about the institutional reference points. There are 7 of them. You need to learn which of them come first in the order of importance and which one we would like to pay attention to. Okay, so price traded into a mitigation block as outlined here, a mitigation block, and had a sell side imbalance and a buy side inefficiency. Then we see that impulse or displacement to the downside that created another sell side imbalance and a buy side inefficiency. Okay, so price traded into a discount of this range between the low here to the high. This is the current daily range on the monthly time frame. So let's have it outlined. The low to the high, that's the current dealing range on the monthly time frame. Okay, so we see price trade into that discount, a bit discount, just a little below 50% of this entire range. When you use your Fibonacci and measure between the low to the high of that range, you would see that that's below 50%, and anything below 50% can be referred to as discount. Okay, and anything above 50% is premium. So then we would like to see this market trade into premium before we start to rebalance these imbalances. And I can see that there is a bullish mitigation block right here, okay, that institutions may want to reprice into this mitigation block, and we have a lot of imbalances. This buy side imbalance, sell side inefficiency has not been refilled. There's a tiny fair value gap right here, and all of this what is it called now, the buy side imbalance and the sell side inefficiency, the liquidity void. We like to see institutions reprice into this bullish mitigation block. But before that happens, we may want to see institutions reprice this dollar a little bit bullish, and this is in confluence with the current seasonal tendency of the dollar, which is bullish. So the current seasonal tendency of the dollar is bullish, so we still expect to see a bit of bullish repricing on the dollar index. So where am I expecting to see the dollar trade into on this time frame, which is the monthly time frame, is that I'm going to outline institutional reference points that I think the dollar is going to trade into, okay, before it starts to go down into from late May and into June. We like to see the seasonal tendency should change to bearish. Okay, but before that time, current institutional order flow, as we see here, is that the dollar just traded above the previous monthly high. Remember, all previously in the last 2 months we've been seeing the dollar taking out the previous monthly low, took out the previous monthly low. All right, this is the monthly time frame. So each new month is taking out the low of the previous candle. Okay, you can see that this candle took out the previous low, so that's a bearish order flow on the monthly. But this new month we see price formed a failure swing, okay, on the monthly time frame, and it took out the high of that previous monthly candle. So where is it trading into? Okay, so I'm outlining the rejection block here, that rejection block, the rejection block right there. I'm outlining that. So I would like to see the dollar trade into this rejection block of the monthly time frame. Okay, then we have a sell side imbalance and a buy side inefficiency. That old high there is a buy side liquidity pool residing above it, and the imbalance above it, that's the draw on liquidity. You can see that, right? The low to the high here, that's a sell side imbalance and a buy side inefficiency, and 50% of this range is called consequent encroachment. Alright, that's 50% of a large imbalance or fair value gap. It's called consequent encroachment, the CE. So we are still paying attention to all of these levels. As the dollar starts to go up, that's where I'll be paying attention to. That's where my attention is going to focus on. Okay, so you can see that's 50% of that fib level. Okay, where it's 50% is right here. Okay, that's 50% of that fair value gap. So these are my levels on the monthly time frame. Just go down to the weekly time frame. What we are doing now is called the top-down analysis on the weekly time frame. Okay, I just hope this makes sense to some of you, and if you are new here, you may want to watch the rest of the videos on the channel so that you really learn and understand what we are doing. So this is the weekly time frame. Just notice how the dollar traded into that fair value gap after it swept sell-side liquidity pool residing below the relative equal lows here and the old low here. Price traded into that level, retested the level here to form failure swing, which is in sync with seasonal tendency, and we start to see a bullish institutional order flow because the weekly candles has been taking out the previous weekly highs. That's a bullish institutional order flow. Okay, so last week we saw how the dollar traded into a fair value gap. So this is the current weekly dealing range. What's the current weekly dealing range? Between the high here to the low here, that's the current dealing range on the weekly time frame. Okay, so price has traded into this fair value gap right here. Okay, traded into that fair value gap, so we are paying attention. We might see a bit of repricing into this impaired fair value gap. What's that impaired fair value gap? You see this 3 candle price action where there is no imbalance, but we see that there is a large candle wick between the first and the third candle. So we are going to measure 50% of that candle wick. That's an impaired fair value gap. So just pick your 50% of this entire candle. This is 50% of the wick of the candle, not the candle entirely, just the wick of the candle, or rather, let me just do this, the wick of the candle. You can see that. Drag it out. Then let's measure the other candle, the third candle. This is the first, this is the second, this is the third. So the 50% of the candle wick of the first and 50% of the candle wick of the second, of the third candle, I meant to say. So let's do. Where is 50%? This is 50%. Just pick this and bring it to 50%. So this is our impaired fair value gap. It's a type of imbalance. Okay, so if the market opens, the dollar may want to trade into this level before it pushes up higher, or the dollar may just want to trade into this fair value gap right here. Okay, I don't like these big horizontal lines, that's why I'm taking them out. So we have another fair value gap right above here that the dollar may want to trade into that level before it comes back into this level. But a gap open higher is going to tell us whether we're going to have a bullish week or a bearish week, and a gap open lower is going to tell us that it's an indication that we may have a bearish week. Okay, these are just probabilities, guys. So this is how I look at the market. So this week, as the market opens and we see a gap open higher, price may want to trade into this level to form the low of the week on the dollar by simply trading into this impaired fair value gap. Then we have a push up, or once we have a gap open lower, price may want to trade into this fair value gap here to form the high of the week before we start to go down. So this will happen between Monday, Tuesdays and Wednesday. We expect to see price from the high or the low of the week. Where are we expecting to see price from the high or low of the week? It is these levels that I outlined. Alright, low of the week possibly around this region. Okay, high of the week possibly around this region, whichever is the case. Then we go down to the daily time frame, and let's see if this is giving us a meaningful idea. All right, so this is the daily time frame, and this is where we are currently. Okay, we might see the dollar trade into this level. On the daily time frame, we have an interesting point of interest. You can see that this is actually a volume imbalance here. There's a tiny volume imbalance. Okay, there is a tiny volume imbalance here. We are paying attention to that tiny volume imbalance, and if you use the dealing range on the daily between the low here to the high, because what happened on the daily here is we had a shift of market structure. Price traded into a mitigation block right here. Okay, this mitigation block, price from the higher low broke structure. This mitigation block, price traded into the fair value of that mitigation block. Alright, then give us an expansion to the upside. We might see price again trade into this bullish order block. You see this bullish order block here that has a fair value gap. That is also a high probability institutional reference point, especially the other block that has a fair value gap. Okay, this bullish order block that has a fair value gap, institutions might trade into this level to form the low of the week, and we push to the upside. All right, however, as the market opens, we will get to find out what the market wants to do. All right, so we just follow what price action is showing us. Then we just go to the 1 hour time frame. On the 1 hour time frame, we just wait patiently and see what the market wants to do as the market opens. So price gave us a shift of market structure after it traded into that weekly fair value gap. Look at what happened. We had a shift of market structure to the downside, which is bearish. Price returned into that mitigation block. You can see that here, right? The mitigation block here, price sold, went back into the bearish order block. I'm still expecting to see price go down to trade into that level as outlined. This is the daily bullish order block that had a fair value gap attached to it. Okay, this is relative equal lows. Price might want to take out the lows here and trade into that level to form the low of the week before we go to the upside. And if we are going to the upside, you can see that there is a pool of liquidity residing above these highs, isn't it? A pool of liquidity residing above these equal highs. So that will be the draw on liquidity. Subsequently, that is that about the dollar. Let's just go to GBPUSD, which is my favorite foreign currency that I like to trade all the times. Alright, so let's take this out. So just go to the monthly and see if we have something on the line on the monthly time frame. Okay, so I did some markups that I'm just going to use to explain this to you. I did some markups during my... So this is the monthly time frame. We've had a bearish order flow. Price took out the low. Now we are in a bullish order flow because we've been seeing the monthly candles taking out previous monthly highs. Meanwhile, this is also a repricing into a premium region between the high to the low of the monthly. We like to see price retrace into the premium institutional reference point. What am I looking at? I'm looking at this sell side imbalance, buy side inefficiency, and I'm looking at another fair value gap here. All right, and a bearish order block that institutions may want to reprice into. However, for that to happen, we like to see price trade into this bullish order block. The last sell candle here that was traded by these two bullish candles, that's a bullish order block. But because we are on the monthly time frame, we outlined 50% of this bullish order block. It's called the order block mean threshold. That's what you have here. Bullish order block mean threshold is 50% of this bullish order block. The low to the high was raided through by these two bullish candles. 50% of this sell candle, when you measure it using your Fibonacci between the low to the high, 50% of it is this line I just put there. It's called the order block mean threshold. I'm expecting to see price trading to that level. Okay, then just go down to the weekly and see. So on the weekly time frame, you can see that this is the current dealing range between the low here and the high here, that's the current dealing range. That's the current dealing range on the weekly time frame. Okay, so you can see that price is currently at a premium. We like to see it trade into a discount before we buy this GBPUSD. all right, we need to see it trade into a discount. It's simple. So what are the institutional reference points we are seeing in a discount? You can see that we have a bullish order block mean threshold on the monthly time frame and is confluencing with a lot of liquidity void, or you can call it the buy side imbalance, sell side inefficiency, a one-sided price delivery that has not been interrupted by an opposing price action. And I'm seeing also a volume imbalance, a fair value gap. All these are going to be the drawn liquidity. They are going to be the reason why GBPUSD should sell into this level, should sell into a discount, because of these imbalances. Because when the institutions are moving, two things makes the institutions move. Number one, liquidity residing above or below the marketplace, either sell side liquidity residing above equal highs, or buy side liquidity residing above equal highs, or sell side liquidity residing below equal lows, or buy side liquidity residing above old highs or relative equal highs, or sell side liquidity residing below equal lows or relative equal lows. All right, then another reason institutions will move are because of imbalances residing within an internal range. All right, when price takes out an external range liquidity, which are the buy and sell side liquidity pool, institutions would like to reprice. The algorithm would like to reprice into an internal range liquidity or inefficiencies or imbalances. Okay, so this is that imbalance. This is the reason why GBP should go down. Then just go down to the daily time frame. You see how I'm doing my top down analysis, right? All of this movement here, or all of these price movements, there is a pool of liquidity residing below this guy. It's called the low resistance liquidity pool. A low resistance liquidity pool usually form in this pattern when price keeps forming relative lows or highs. You keep seeing lows that are relatively close. So all of this guy here, there's a pool of liquidity residing below it. Some people call it diagonal liquidity, whatever it is. Okay, so where are we now? Look at what happened last week. We had a shift of market structure. Price traded into that week, that daily sell side imbalance, buy side inefficiency, and also institutional order flow entry drill type 1. Then price expanded to the downside. Price traded into this bearish order block. Okay, the bearish order block, and price is showing willingness to go down. All right, so where is it going to trade into? Where is the drawn liquidity? The liquidity pool residing below this relative equal low, all of these relative lows, old lows or relative equal lows here, and ultimately that our weekly fair value gap, which is in confluencing with a bullish order block on the daily that has a fair value gap. That's high probability. Okay, so how are we going to go down this week? I'm expecting to see GBPUSD after the market opens. I would like to see GBPUSD trade a little bit higher from the high of the week. It should take out this previous high, or it should trade into 50% of this candle wick. You can see it outlined here, right? 50% of the candle wick is also a point of interest, or I would like to see it trade into this order block mean threshold, the bearish order block here. 50% of it is this line that you saw me already place. That is bearish order block mean threshold. So I'd like to see this guy trade into this level before it starts to dump to the downside, to form the high of the week before it starts to dump to the downside. Okay, so as the market opens, it's going to show us how this thing is going to happen. So this is the 1 hour time frame. Price gave us a shift of market structure. All right, then traded into this tiny fair value gap. You can see it here. That's a model on its own. This will have been the entry after creating an external range. Price traded into internal range liquidity. That will have been the entry. Then we saw that expansion to the upside into what? Another mitigation block that has a fair value gap, or bearish order block that had a fair value. Then price turned to the downside. Okay, so as the market opens, a gap open higher tells me that we may have a bullish week. A gap open lower tells us that we may have a bearish week, or a gap open higher may tell us that we may have a bullish day to form the high of the week, or a gap open lower may tell us that we may have a bearish day. So where am I looking to see price trading to? I would like to see this guy, this GBP, take out this previous high or old high and trade into that other block mean threshold of the daily time frame. This is in confluence with a rejection block on the 1 hour time frame. Okay, then before we start to short this guy to the downside, as the dollar keeps pushing in confluence with the seasonal tendency of the dollar. All right, but we keep watching and see what the market is going to do. So if the market reaches this my point of interest, how am I going to execute? I will patiently wait on the 1 hour time frame to see price create an external range. Then I will execute on internal range. What do I mean? If price should trade here, I would like to see it do something like this, create an external range. All right, that's the shift of market structure. Then I would like to execute once price returns into internal range, fair value gap order block, then I execute. Or I would like to see price do it this way, forms a mitigation block, failure swing, all right, and then creates an external range. Then when price returns into internal range, I would like to execute. So that's how I'm going to go about it. Guys, if you like this video, please don't forget to like this video, make sure you share this video, make sure you subscribe to this channel, and of course, if you are looking to get funded with a prop firm and get funded to as much as $1 million in funding, you can quickly click the link in the description of this video and get started with the Forex Founder, because they are the sponsors of this video, and get yourself an account that suits your trading personality and suits your goal, financial goal for the month, for the year. Get started, guys, get funded, make withdrawals, let's make this money together. Until next time, I wish you good luck, good trading, stay safe.